From my side, my name is Thomas Poppensieker. I'm the chair of this second panel. I think we had a very interesting morning today with Christine Lagarde. We were a little bit hit by the fact that there's a snowstorm over Berlin and Mr. Schäuble couldn't join us. So I'm already announcing that unfortunately Mr. Schick, who was also supposed to join us in the second panel, was kind of caught in the same situation. So we have unfortunately to reduce the size of the panel. New capital requirements and their impact, that's the headline. And I'm very honored that we now have the opportunity to listen to Anshu Jain, co-chairman of the management board and the group executive committee of Deutsche Bank, to listen to his keynote speak on the changes to the European banking landscape. Also here with a little bit of a hint that he just for us stepped out of a supervisory board meeting, as I understand it, and therefore, unfortunately, will not be able to join us later on in the panel conversation. But Anshu, the floor is yours, and we are all appreciating that you took the time to join us.
Thank you, Dr. Poppensieker. Good afternoon. Welcome to all of you. It's a pleasure to be here at the Frankfurt Finance Summit. We have a vested stake in Frankfurt, and it's terrific to see the great and good all here at a time which is certainly of great interest, not just to Deutsche Bank, but really to all of us. So in my 20 to 25 minutes that I have with you today, I've chosen to select three themes which are related. My views on the developing macroeconomic and market environment, the evolution of the European banking landscape, and then the potential consequences for growth and competitiveness in Europe. So let me start with the broader market and economic outlook. And I have to say that when assessing where we stand today, it's important. We can get lost in the daily hubbub of the headlines, but I think it's important to take a minute and look at where we're coming from. Just a year ago, Italian bond yields were signifying an implied probability of default of near 50%. Now, it was very difficult for markets to function normally all around the world, let alone Europe, with that kind of a terrifying probability. 2 trillion euro economy with, to be precise, a 46% probability of default. A scant year later, frankly, because of very firm, very good leadership right here in Germany, and an unprecedented set of steps taken by the ECB, regardless of what we think of them, that situation has stabilized and stabilized dramatically. That implied probability of default has dropped to below 20%. Does it mean that tail risk is gone? No. But does it mean that the tail risk has been truncated? Its probability dramatically reduced? The answer decisively yes. What has that created? It's created stable and actually fairly attractive financing levels for these European governments, which, when allied with the recovering investor confidence and business confidence, means that the overall picture in Europe has stabilized. Now, I know what all of you are thinking. What price Cyprus? Look, it was not an easy proposal to make, I'm sure, but it does represent a clear path of reduction of debt to GDP from 170%, which was unsustainable, to 100%. We see near-term contagion risk as limited, and it's unlikely to be a model for other EU states. However, as a precedent, it does widen the scope for bail-ins in a way which could negatively affect investor sentiment if another peripheral country were to get into difficulty. Now, what does that mean for European growth? That combination means that the chance of a dramatic event in Europe has receded, although growth, the way we see it, is still going to be slow for a long time. Now, if we head west from Europe and take a look at the US, there the signs are almost unequivocally positive. And there's really two things that I focus on, maybe three, which stand out for me. First and foremost, in the US, the state of the housing market has always driven the overall macroeconomic environment, and that's the case again. So the fact that house price decline has now slowed down and in fact is picking up speaks very well for consumer confidence and bank health, even more crucially. At the same time, household deleveraging is coming to an end and domestic consumption is picking up. Finally, thanks to shale gas, the US is picking up a tremendous competitive edge when it comes to its energy policy versus the rest of the world, which of course is good news for everyone else, because as that big, powerful economy accelerates, it spells good news for global growth. This time last year in Asia, there was a lot of discussion around a very hard landing. If anything, those fears have now shifted to the risk of overheating. So I would summarize my sentiments on the macroeconomic environment and the attendant reaction in financial markets as one where we are somewhere near best case scenario versus where we could have been on projections from a year ago. Doesn't mean that all the problems are gone. Some very significant risks remain, but there's a reason why equity markets have rallied, credit spreads have tightened, interest rates for sovereign debt are at record lows, and correlation has dropped. There's a reason, and these are all positive signs for investors. If I were to summarize my views in the first section, I would say all well, barring two things: an extreme tail event in Europe, of which we don't think Cyprus is one, and this is a forecast I could learn to regret over time, but certainly that is the way we see it currently. And secondly, and most crucially, a faster end to this artificial low interest rate environment that we currently see. I view that as the greatest risk to the global macro outlook. The fact that we are underpinning a lot of this optimism, not based on real structural reform, but we are overly dependent on some superhuman activity by central banks and central bankers. That then brings me to my second topic, which is this inflection point which European banks find themselves at. Now you may ask, why is it an inflection point? The crisis happened 5 years ago. Surely that should have been the inflection point. That's not the way we see it. I think the period of 5 years post the crisis was a period of artificial calm. Regulators were busily trying to restore stability. Most banks were scrambling to fix the multitude of problems that had been uncovered, and sovereign balance sheets were being repaired at the same time. That was not the time for decisive action. 5 years on, we finally see those tectonic plates shifting. And in my view, 3 models are emerging from what used to be a somewhat more confusing landscape in Europe. Let me walk you through each of them. First and foremost, we have what we could call focused, some would call more niche players. Examples would be European savings banks, mortgage banks. And they have considerable strengths. Right here in Germany, the Sparkassen have actually managed their costs very efficiently. They've achieved good cost-income ratios despite this very low interest rate environment. They're perceived to have loyally supported small savers and depositors, and that has got them a tremendous amount of goodwill in the eyes of politicians and regulators, and this is a theme I'll come back to, which gives them a very significant competitive advantage. These are the so-called good banks, and it's very clear that the role that they're playing in serving society and clients is being well recognized and is earning them support from regulators and politicians. The second category would be the national champions with a wider European regional presence. Now, in this category, I would put a number of banks which 5, 10, 15 years ago would have actually described themselves as having global ambitions, but certainly in the period post the crisis have shrunk their balance sheets, shrunk their platforms, and have really gone back home to focus very much either on national needs. They've become, or always were, national champions, only now they're really focused on that role. Many still harbor European ambitions. Most have given up their global ambitions. Now, that's a good thing. Their balance sheets are stronger. Their complexity has been reduced. Again, their cost-income ratios are dropping, and they're moving into alignment with their regulators and their national leaders. Is all well then with this model? Not really. It makes you very dependent on the sovereign balance sheet on which you support. Your model is now much narrower. Your diversification is far lower. And particularly if you happen to be domiciled in a country which is still not out of the woods, which, let's face it, for Europe is more than half the countries, actually it's arguable whether your model is safer now than it was before. It's just become more concentrated. And certainly post the ECB action, the bank stocks which belong to institutions that fall into this category have reflected great optimism. Now, it wouldn't surprise you that I'll spend the bulk of my time now with you on the third category, which is the global universal banks based right here in Europe. This is where the greatest challenges have come. The crisis hit these institutions very, very hard. And not only were the financial repercussions of the crisis grave, I think the social political repercussions have been graver still. Into this category fall a number of banks which legitimately had global aspirations, hence had big, complex models, had large balance sheets, and weathered the crisis less well than some of their competitors. Now, this model actually faces an existential question, sometimes explicitly, sometimes less so. But the question that people get asked now when they represent these institutions, should we even persist with a global universal bank out of Europe? My answer to that, not surprisingly, overwhelmingly, is yes. This model has many strengths and brings unique benefits to society. These banks are well diversified, both by geography and business, as well as funding. These banks have scale advantages, and as a group have achieved higher returns in recent years. They provide clients with a range of services on a global basis, with lower costs and improved access to credit through more efficient allocation of capital. The liquidity they provide lowers costs, especially funding costs, for international corporates and governments. These banks have also made tremendous progress since 2008. They've added €1 trillion to capital and reserves. They've doubled their core tier 1 capital. They've reduced balance sheet leverage by approximately a third. VaR has been cut by more than half. Business models have been narrowed and repositioned away from proprietary trading, complex exotic derivatives, back to more vanilla activities. Compensation, most crucially, has been cut and continues to be cut very significantly. Most particularly, the regulatory regime, which has been focused for all banks, but particularly for this sector, is Basel III. And I have to make a very clear statement here. Basel III is a very good and a very necessary piece of regulation. And it covers almost every aspect of banking activity, starting at the Pittsburgh G20 summit in 2009. Now, why does it take that statement of support? Because Basel III implementation is being questioned. And there's no doubt that, like all pieces of regulation, it has its weaknesses. Yet the fact that it's been accepted, the fact it allows you to compare a bank in Beijing to a bank in Mumbai, to a bank here in Frankfurt, London, or New York, and to have that level playing field then be established is a huge advantage. In my mind, Basel III also goes to the heart of the too big to fail and the cost to society of having to support banks question. Now, of course, in addition to that, this set in particular faces a raft of supplementary regulation. Let me give you a sample of them. There's legislation which is designed to challenge the universal banking model itself, whether it's Vickers in the UK, Liikanen, or the variety of variations on Liikanen. Capital regulation out of the US, which to me is probably the most significant step away from global harmonization that we've seen. In that period post-2009, the notion that all countries came together, all banks came together to avert and fight the aftermath of the financial crisis was one of the real positives coming out of the financial crisis. And yet, for the country which is acknowledged to be the leader in global banking, to be announcing a set of rules which is unilateral, doesn't fit with Basel III standards, uses a timeline which is independent of Basel III, and some would even say has an implied questioning of collegial resolution and recovery mechanisms, is creating a fair amount of comment. The questions that are being raised are legitimate questions. The US does have a very significant role being played in their domestic marketplace by foreign banks. That concern is legitimate. We are in consultation period, but it's clear these rules go against the run of play. And of course, then there is a raft of Europe-specific regulation, whether it's a financial transactions tax, it's certain types of bank levies, most recently compensation reform, which are affecting global universal banks uniquely, particularly if they have a European domicile. Now, the question we should ask ourselves is to step back and say, what is this legislation, this regulation, hoping to achieve? Because surely in my mind, it should be the common agenda for regulators, society, and industry to allow banks to fail. That has to be the goal we have to all work towards. Now, some in the audience might be shaking their head saying, why is the co-CEO of a major bank standing here saying my goal is to allow banks to fail? Because the answer is very clear. The price we pay through constant intervention makes the full functioning of a capital allocation mechanism very, very challenging. So, of course, the rider to that is we have to allow banks to fail without systemic or market consequences. And in my mind, if you take a look at the bank failures that have taken place and we study the lessons learned, I feel Basel III goes all the way that you need to in order to get banks to the point where they should not have to rely upon aid from any other mechanism. And of course, a lot of the regulatory overshoot, which is coming post that, one has to question how exactly it's going to help address the main question. What it does do is that it creates a non-level playing field. And in my mind, European global universal banks particularly are now at a clear risk of regulatory arbitrage. And the reason I say that is because all of the legislations I've talked about, once we get beyond Basel III, are now unique to Europe. Now, these rules are still in development. There still is a fair amount of consultation going on. We are obviously working on mitigation steps. So certainly at the Deutsche Bank business model level, it doesn't mean that these rules fundamentally affect the way we operate. But we are really hopeful that we will find a way to really address the unintended consequences by working closely with regulators. Let me talk about some of the unintended consequences next, which is the third part of my time with you today, which is the potential consequences for Europe's growth and competitiveness. And this, of course, assumes the full application of all of these measures, many of which, as we know, are still being discussed. The bigger picture for me is that Europe is under pressure to compete as the global outlook improves. So as we enter now the post-crisis era, and if we recognize that we have a US economy which is powering ahead powerfully, is resilient and increasingly energy independent, and it does appear that the Asian growth story appears to be unchecked and very strong, there's no doubt that we have to now start focusing on the three priorities which Mario Draghi very recently talked about. The three elements to European recovery: confidence, credit, and competitiveness. And in my mind, regulatory overreach has clear consequences for all of that. Let me expand on that a little bit. From our experience with clients, large corporates definitely need an integrated global offering of global universal banks. There's no doubt that that is something which they will need in order to grow their business. For highly globalized Mittelstand clients, the combination of global network and intense local bricks and mortar coverage is something which only a European-based global universal bank can offer. I can offer you a personal example. Very recently, as I've traveled across Germany, visiting Mittelstand clients, several things strike me. First is the continuity of capital. It's astonishing how the family-run model is unique and has not been replicated anywhere else because it takes immense discipline. For 200 years, often 300 years, a family has reinvested everything which it had back into that business, has lived on dividends, and not even all the dividends. Everything else has been plowed back in. Now that's got one huge advantage, which is you've got that tremendous continuity of private capital. Of course, the concern is that these are not rated public entities as they would elsewhere. They're very dependent on their banking relationships. And your typical Mittelstand is doing business in 70 locations, but has a finance department of 5 or 10 people. So to not have a global bank with strong local roots that they can lean upon, which can give them cash clearing in the Philippines, cash management in the US, foreign exchange management when they export to China, would be a significant competitive disadvantage. So in my mind, this global-local combination is particularly important for Germany, given the importance of the Mittelstand and prevalence of highly global hidden champions. Because let's not forget, the Mittelstand is not a domestic industry. This truly is dependent on global growth. And of course, from a competitiveness standpoint, the combination of integrated global services across financing, advisory, and risk mitigation services, access to credit, and deep local networks means that Europe's global universal banks contribute meaningfully to the growth and competitiveness of European business, not just domestic business here in Germany. In Europe, global universal banks play a vital role in the availability of credit. So approximately 70% of all the credit creation in Europe happens via banks. In the US, that ratio is neatly inverted. Roughly a third comes from banks. All the rest comes from capital markets, in part because you have many more listed companies which also have credit ratings. I think the one thing which has not been addressed enough, though, is when we talk about all the other advantages of a global bank, is Europe would risk losing its voice as the future global financial industry regulation is developed. So post-2008, the reason Europe's had a voice in the formulation of Basel III is because it had global universal banks. It would be a great pity if we were to shrink right back to our domestic roots, because what that would mean is as the future of global financial regulation, or indeed global financial matters, is discussed, that seat at the table would then be gone. So to bring it then to Deutsche Bank, we are committed to being a global universal bank. We're committed to system stability, committed to strengthening our capital base faster than any major peer, which is what we did last year, and maintaining high-quality liquidity and funding profiles, because you cannot be big and complex and not have very stable funding and very deep capital. Those two go hand in hand. We need to put our model to work for clients. Some examples. Last year, we helped 300,000 clients in Germany buy a home. We helped 60,000 small businesses start or grow. We helped 180 clients gain their first ever access to capital markets. We financed 57 billion euros of international trade. And we helped 8,000 corporate or institutional clients reduce currency and other risks. And we're not sitting still. Many of you may have read the announcements which were put forward by Jürgen Fitchen, where we have announced our desire to service our Mittelstand client network out of our retail bricks and mortar branches, because we feel that transfer will really help us anchor and improve our services to that very important client sector. So, in essence, let me conclude. When it comes to markets, major tail risks have receded, but for Europe, lasting recovery depends on a clear path to growth. The agenda really has to move on from stability to growth. And here, Europe's global universal banks can and should play a vital role. The wider risks and unintended consequences of regulatory arbitrage are real for banks and for the economy. We are nonetheless confident of finding agreed solutions with regulators. In my dialogue, whether it's in Bonn or Berlin, the discussion is very reasonable. The agenda is mutual. You don't always find the right solution right off the bat. These are complex problems that will take some time to figure out, but I have to say the quality of the dialogue so far has been very encouraging. And in conclusion for me, it would be essential for the financial industry, business, regulators, and legislators to continue to work together on a path to lasting growth-driven recovery for Europe and to ensure its ongoing competitiveness. Thank you for your time and attention.
Anshu, thank you very much. I think a very challenging discussion will follow after this to digest what you have laid out for us. Let me now introduce the second speaker, which originally was supposed to be Michel Barnier. Unfortunately, he had other commitments, so instead of Michel, we now have Elmar Tertag, Principal Advisor to the DG Markets section of the EU Commission, and he will also share with us his perspective on Basel III and capital requirements.